Rule 604 of financial markets: desynchronization causes losses. Your losses are not caused because you don't know what you're doing. They're caused because you're desynchronized. In this video, we'll examine ways that you can get more synchronized. Because Rule 603 is synchronization profits. We're going to look through Tesla, as well as Apple, as well as a range of Tier 1 charts. Tier 1 charts move the markets globally. If you do not understand Tier 1 charts and what they mean, you will become desynchronized. We'll have a look at the smart money buy and sell levels, or Standfield levels, and see where the algorithms are hanging out. Stay tuned, it's going to be a lot of fun. Hi everyone, I'm Ken, the inventor of the CTKS method. If you're new, a very warm welcome, and welcome back, CTKS family. If you'd like to know where smart money is buying or selling, please subscribe. And don't forget to smash that like button. Looking at the main markets in the past trading session, and masterclass students, you get my live chart in TM6. One of the best things that we see here, the DXY strength is starting to fail. Yields have not continued spiking up. This has been very good for Bitcoin, which is the blue line overlaid on all of these charts, and it's been good for gold. The major indices are also liking it, but look at the NASDAQ, it's just stuck up there. We're seeing the VIX continue to fall, and junk bonds are staging a rebound/recovery. This could be really good for the markets. We were at a pretty critical stage with the markets yesterday, but risk has come back in, and thank goodness for that. That risk-on activity has flowed, of course, into the crypto market, and we've seen Bitcoin rally up. Comparative to Ethereum, Ethereum is performing slightly better than Bitcoin at the moment. Binance Coin, BNB, slightly better than Bitcoin. XRP also slightly better. And when we look at poor old ADA, ADA was doing better but is now not so much. Doge doing better than Bitcoin, just marginally. Solana just about equal but just a little bit better. And Matic showing a bit of strength. Wow, good on you, Matic. We know that no alt can escape Bitcoin's gravity. When Bitcoin comes up, the entire crypto market comes up with it. The greatest gainers past 24 hours: Luna C, Immutable X, EOS, Render, Uni, Matic, Cake, Gate Token, and Mina. The greatest losers, top 100 past 24 hours: LDO, Sui, FracShare, Clayton, Nexo, Synthetics, Carver, Stacks, and Algo. And a lot of people would be very happy that Pepe is not amongst them. Bitcoin is currently trading at 26,556. We have a Standfield level below at 25,923 and one above at 27,019. These SLs, or Standfield levels, are formed through the CTKS method. The CTKS method is the world's most advanced smart money buy level and sell level detection system that you can apply to any price chart, and you can learn it yourself. Literally learn once and apply for a lifetime to think and profit like smart money. When we look at the SLs within Bitcoin's price structure, we can see this one down at 25,928. If price gets negatively biased, it will move towards this level, but if it breaks out, it will move up to the 27,000 mark. This is what you need to be aware of in terms of internal market structure. Price is literally always moving from Standfield level to Standfield level. If it gets above one, it's going to the next. If it can't stay above one, it's going to the one below. It's pretty straightforward. One thing that we've noticed in Bitcoin, when we look at the longs and the shorts were whacked quite substantially, causing a bit of a pump up in price. The shorts have not regained their composure as yet. There were a lot of negative signs being thrown inside the financial markets yesterday. We saw that in yesterday's episode, but things changed so quickly. We must change quickly with the markets or we will lose our synchronization. A lot of people dig in on a specific choice for where price action must go. They'll say it must go up, it must go down. One of the problems is price is always moving in a wave. Rule 4 is very, very important for your synchronization. Remember, if you're synchronized, you will create profit. If you are desynchronized, losses will follow. It's that simple and that complex. The markets are always changing character. That's why you have to be really, really aware of what the Tier 1 charts are doing. The Tier 1 charts are literally the engine of financial markets. If you don't know the health of the engine when you pop in the car, that car may not go anywhere. To know what smart money knows, to know where the buy-sell algorithms are, we apply the CTKS method. You can see that the VIX was holding the line and then dropped. Why did this occur? What was happening with the market structure of the VIX? To answer that question, you can just pop on your indicator, which is part of the CTKS method service. You notice this very strong Standfield line. When it went under, it was heading to the next one. And it went under that, it's heading to the one under that. When we look at the one under that, and you can see all of these levels inside the monthly service, we can see it's a long way down. The thing to always note, these are gravitational trampolines, either ceilings or floors. We must know where the floor is and we must know where the ceiling is. The VIX is trying to get above this ceiling at 1370. It closed out at 1365. If it does, the next path is to go up to this 1384. If it gets above that, the next path is to 1415. You can observe price action in its own natural environment. You don't have to overlay what you think price will do. Just observe it. For the foundation members inside the service, the US 10-year, US 2-year, Apple, Tesla, and Ethereum have just recently been released. You can just pop in there and grab those indicators. For example, when we're looking at Tesla's price, we know that the CTKS method reveals where smart money is buying and selling. It reveals true support and true resistance. Let's pop on the indicator and see what is cooking. We know one thing. Price is always moving Standfield level to Standfield level. And we do definitely have a rule for that, Rule 654. When price moves from SL to SL or Standfield level to Standfield level, it just gets rid of so much complexity inherent inside financial markets. It was 37 years ago when I started my finance degree. I've been in the finance industry for a long, long time. In 2005, I wrote the book Intangible Finance Standards in Advances in Fundamental Analysis and Technical Analysis. I know both FA and TA. This book was published by Elsevier Science, one of the US's leading academic book publishers. Therefore, when I say the CTKS method is the world's most powerful and advanced smart money buy and sell level detection system, it is. And you can learn how to do it yourself inside the masterclass, or if you want to know just the levels, you can do that at ctksmethod.org. When you're looking at a chart, it's absolutely critical to know where the safety nets are and where the ceilings are. And by popping on the indicator, you can see both. One of the things that we saw with Tesla around the 6th of June, it just pumped up across this smart money sell level at 222. Where was it going? It was going towards the ceiling. And if it didn't make it, where was it going to then? Going back towards the floor. If it got through the ceiling, and that's fairly heavy ceiling there, it would have to crack through it and obviously consolidate. If it had positive momentum, it's going to the next SL at 233. And if you're inside the service, you know what levels are above that current price. Financial markets can often be perplexing. I know, I wrote a book on fundamental analysis and technical analysis and advances in both. I developed new branches of mathematics, especially financial mathematics, that allowed us for the first time to financially value the impact of intangibles, knowledge, collaboration and processes, as well as staff engagement on market value and share price in the stock market. I know the conventional markets, and I also know other markets such as crypto. The most important thing that you can do as an investor or a trader, and a lot of investors don't think they're traders, but they actually are. Every investor becomes a trader anytime you buy or sell. Traders are very surgical with their buy and sell decisions. Investors are very surgical with their holding periods. Combining both is the way to go. The Apple indicator was released just recently into the CTKS Method monthly service. Let's just pop it on to see where smart money is buying and selling. We can see that around that particular level, the 178.19, there was quite strong support, and we can see up here at 180.91, a strong ceiling. What's price been doing? It's been rebounding between SLs. SL to SL, Standfield level to Standfield level. What we can see now is Apple is coming up to some fairly stiff resistance at 180.93. If it makes it above that, it's heading to the next SL above that, and the minor SLs give you an idea of support and resistance inside the market. One thing to be aware of, the CTKS method is unlike any other technical analysis method, and you can only learn it inside the CTKS Masterclass or ctksmethod.org. It is not available anywhere else. One of the things that the CTKS method does, it marks up all of price history since the inception of price. With Apple, that's 1980. When you're looking at levels, you are looking at the levels. It's critical to understand where the safety nets are. For example, if we turn on the indicator for Binance Coin, BNB, when the SEC action came out, Binance Coin went to test the 269 level and it fell through it. It fell down to the next SL, which was 255, and you can see it's been doing reasonably well since then. But the issue is, when it was cascading down like this, many people would have thought it's going to zero. No, it's going to a Standfield level. Many people think the opposite way. When price explodes, it's going to the moon. No, it's going to another Standfield level. A lot of people only trade the chart that they're putting money into. This is a very, very big mistake. There are two predominant mindsets inside financial markets, the professional one and the retail one. Unfortunately, the majority of people have the retail one. The professional one is what you get after many decades inside financial markets. It's not an easy mindset to get. What is this non-easy mindset? Professionals look at the market's pulse. They don't just trade the chart that they put money into. They look at what they don't put money into, especially the tier 1 charts, which are literally the engine of financial markets. They must understand the structure and interdependency and interplay between the tier 1s and how they relate to those charts that they're trading or investing in. One of the things that you see with professionals, they understand that price is reality, not the news, not anything else, just price. Professionals are calm and balanced. They have an abundance mindset. They are patient. They're independent of the news, and they are their own financial advisors. They have high levels of knowledge and flexible rules. They always do their three-dimensional risk management, and they do their analysis. This is very much in contrast with, unfortunately, retail. Retail only invest and only looks at the chart they're putting money into. They use a thing called RIP, which is recent indicative price. And you can see it everywhere when you know what you're looking for. RIP will RIP your money. If they're not using RIP, they're using SBA. What's SBA? It's story-based analysis. That fairy is not there for no reason. Wow, double negative. Said another way, story-based analysis is just fantasy, using high leverage, wanting luck and gambling, being unrealistic about price targets and then getting emotional, angry and blaming is the hallmark of the retail mindset. You do not want to be there. You will become completely desynchronized to the point that you lose your entire account. The market doesn't care about anything except your synchronization. Please be kind to yourself. It's always hard to lose money, but losses are the way that the market teaches us to be professional. Rule 446 is what professionals understand. All markets and therefore all charts are intercorrelated and interdependent. When you're looking at your beloved altcoin in crypto, if you're not looking at Bitcoin, you're in trouble. We've done this so many times on the channel. We've even gone down to a 1 second view of the alts. Lots and lots of alts. And what we see, Bitcoin's gravity is the king. But it also applies to the major indices. If you're not looking at the S&P 500, but you're trading a component of the S&P 500, you're in trouble as well. If you're trading a component of the NASDAQ, you're in trouble if you're not looking at the NASDAQ. And if you're trading a component of the NASDAQ and not looking at the VIX or the DXY, Bitcoin, gold, US oil, junk bonds, the US 10-year and the S&P 500, again, you're making a mistake. For example, Apple Computer, Apple Inc. is in both the S&P 500 and the NASDAQ. Look at this resistance inside Apple. I wonder how that's playing out inside the S&P 500 and the NASDAQ. To answer that question, we must get background information. This is the difference in the process of professionals versus retail. Retail will just pop into it straight away. Oh, let me check that out. Professionals say something different. Let me check out the VIX. The VIX is the fear gauge of the main markets. We can see the VIX is under negative price momentum. But where is the smart money buying and selling? Because all markets are intercorrelated and interdependent. We can see that we actually broke through this very strong support at 1384. We went lower to the next SL, which is what? 1370. Now the VIX is just testing it. If it gets above, we know it's heading towards 1384 or up higher. But if it goes below, we know it's going to the next SL, below it. The VIX indicator is shared inside the monthly service. In yesterday's video, I mentioned that the CTKS method is all about trading the right-hand side of the screen, not the left-hand side of the screen. I also mentioned that the US 10-year yield could have a lot of trouble getting above this 3.8% mark because there's a lot of structural resistance in play. Of course, there are a large number of factors inside the market at the moment, but what did actually occur? Did the markets get above that particular area and then manage to get sustainably above it? No, they didn't. What you can see here is how financial markets work. Just getting above doesn't guarantee you're getting to the next one. You can see this particular weakness. This almost told us that this one wasn't going to actually be possible. When you look at the yields are very, very important to understand. You can see this big drop through. But where did it get pulled back to? The gravity of that 3.79%. And when it dropped, where did it get caught? The 3.755 and the 3.750 mark. You know that these levels were in the chart yesterday. And what are we seeing now? We're seeing a gravitational pull, not to the higher level, but to the lower level, potentially that 3.69 mark. We understand that SLs, Standfield levels, are what attract price. If we find that the SL starts to cut over, and we can see that happening, this potential area 3.755 is in play, and we can see that price is already reflecting that potential cut over there. If we get up to here, we must bear in mind that there's a lot of resistance here, and that's going to be fairly hard to get through. Price to get through strong resistance often dips down like this, gains support, and pole vaults through. We see that all the time in financial markets. And in the past couple of videos, I've been showing how you must keep your eye on all of the Tier 1 charts. In yesterday's markets, the Bank of Canada announced that it would be raising its rate 25 basis points up to 4.75%. But it only had a 45% probability of doing so. That caught a lot of the markets off guard. But what we can see, even though we have this big movement, just think about this. We were down here. We came up to this SL, and we're nearly back to this one. It's like it went up there, and it's now back to around here, and at its slowest, down around this particular point. This is a very good thing to keep in your mind. Price is always moving in a wave. Different levels of support and resistance are very important to understand. And when we look at the DXY, which is what? A flight to safety. Oh, the DXY is going down. What do we anticipate the junk bonds and the VIX are going to do? Please let me know in the comments. And what is the strong resistance or strong support inside the market? The only way to tell is to throw on the CTKS indicator. We can see that the DXY, currently 103.337, passed through this very strong support because price was above, tested it, fell through. That strong support was at 103.845 and also 103.795. When it fell down, where was it going to next? The next safety net. And if you're a member of the CTKS monthly service, you know what the levels are underneath. What we can also see, and this is where you need to bear in mind what's happening with other potential charts. We're getting a short-term crossover here. We've already seen the yield starting to just recover a little bit. What would this do? Would this put this 103.493 level in play? Absolutely. But just bear in mind, the yields are under resistance, the 10-year, and the DXY is under this resistance too. You'll note that their charts are different, but the concept of interpreting these lines is not different at all. Price is always moving Standfield level to Standfield level, SL to SL. Many investors in commodities, especially gold and silver, unfortunately don't look at the VIX, the DXY, yields. They just look at that particular chart and say, I have everything I need to know inside this chart. Unfortunately, you do not. If the DXY spikes and the US 10-year spikes as well, you're going to see negative price momentum inside gold. If it just goes the opposite way and the DXY and yields spike downwards, you're going to see the opposite play in gold. Gold loves inverse real rates, and we talk about that a lot inside the masterclass. The masterclass is about the knowledge. The CTKS Method service is about the levels. Let's throw on gold's indicator and see where smart money is buying and selling. Look at this. When gold just was plummeting down, it didn't get caught very long here at this smart money level at the 1954 level. If it's not going to get caught there, where is it going? To the next Standfield level, absolutely. And we can see a confluence. There's a town hall meeting down here. When you get a lot of Standfield levels hanging out together, this must be a pub or something. When you get that, that's really good for price. If price is coming down, they will support it. They're very positive people when they're under support, these SLs. And what does that mean? If it's finding support here, where is it going to next? You got it, the one above. And if it gets through there, where's it going to next? The one above. If it gets through there, where is it going next? The one above. If it can't get up there, where is it going next? The one below. A lot of people think that marking up these SLs must be so simple. It is not. If you want to make real money inside financial markets, it takes enormous dedication and commitment. The CTKS method applied to gold marked it up from 1833. To mark up your charts with the CTKS method lines, you will require both Level 1 and Level 2 certification. Level 1 certification gives you all the fundamentals, and there are a lot of fundamentals that you need. You also get a certificate. Level 2 certification is where the foundation is built upon, and you can see there's a lot in this. To mark up these charts is not a simple method. A lot of people think it's very, very simple. It is not simple, but the method service is very simple. You just get an indicator, you whack it on, and that is that. We know that the VIX is under resistance at the moment. That is a fear gauge. Another fear gauge is junk bonds. When junk bonds go down, that's not a good sign for the market. In fact, it's a really bad sign. Risk is coming out of the market. Prices are going down. But when junk bonds actually recovers, you will see positive momentum inside markets. But again, where are the SLs? What are the SLs doing? And how strong are they? You can see this safety net here with the junk bonds was at 91.33. Junk bonds are currently 91.58. There was another safety net below at that 91.08, and that held price. You notice this consolidation. We've seen consolidation previously. When you get consolidation, you often get a move in the opposite direction. Where is it going to stop out and consolidate around? The next SL. And you can see it was consolidating above the SL level, above that 91.33 mark. Therefore, it's going up to the next SL. And that's what we're seeing at the moment. There's huge interplay between all of these different charts. When looking at the S&P 500, we saw it selling down. Let's have a look at the indicator to determine where the smart money is coming in to support the price, and they did it beautifully. Look at this. At the 42.69.10 level, they just supported price perfectly, and it's on the way up. And we know the junk bonds are on the way up, and the VIX is under resistance. This is very important for us to understand. There's so many things that link in to why the S&P 500 is going up. It also includes the DXY and the US10Y. Every single chart has a different SL makeup, and this is something that you must understand. We look at the S&P 500, look at this beautiful level of support, and it bounced. Is this exactly what's happening on the NASDAQ? No, it's not. We can see the NASDAQ came down, consolidated, but it's been more suppressed than the S&P 500. Why is that? Because the SLs are obviously playing with price at the moment. The NASDAQ was marked up since 1973, according to the CTKS method. Where is that smart money, sell resistance and buy resistance? Look at it, just pole vaulting through here. What we've seen, this was very, very difficult. When price came down, it found this lower safety net at that 13,205 level. It couldn't hold on to it, so it went down to the next one, which was 13,149, consolidated around it. And you know that the S&P 500, the NASDAQ's charts, are not dependent on those individual charts. They're dependent on all of the Tier 1 charts. You can see the absolute difference between the NASDAQ recovering, and it still hasn't recovered. It still hasn't got above this 13,257 mark. It's just hovering around. It's trying to, but it hasn't got there yet. Look at the stark difference between the NASDAQ and the S&P 500. You can see the strength. You can see the bounce. They're all different because there's no significant SL level in the S&P 500 to hold it back. Hopefully this video has shown you that there's a massive difference between the retail mindset, which is really just a couple of charts, and the professional mindset, which is of course the tier 1 charts and the understanding of market structure or CTKS structure. People typically get desynchronized because they don't know where the SLs are. They use RIP or recent indicative price to draw a set of lines in, and they think that's support and resistance. It is not. Thank you everybody for your awesome comments in the past couple of videos. Kate and I are so grateful to be sharing this journey together with you. Have a great day or night ahead, my friends, and we look forward to catching up with you again tomorrow. Bye for now.